Stocks climb, reacting to Trump's easing tariffs on imports of electronics, computers and chips after a market holiday. Realty industrials are the biggest gainers. FMCG lags.
Auto stocks rev up on expectations of a pause on tariffs for car parts and makers after US President Donald Trump says he's looking to help car makers by giving them time to move manufacturing to the US.
And days after RBI cuts repo rates by 25 basis points and signaled a shift to an accommodative stance, top banks HDFC Bank and Axis Bank have cut rates on savings deposit. The move props up the banking stocks.
The stock of macrotech developers perks up after brothers Abhishek and Abhinandan Lodha amicably settled their differences, with macrotech retaining exclusive use of Lodha and Lodha Group brands, while Abhinandan Lodha will have sole rights on the House of Abhinandan Lodha brand. We are counting down to the WPI data, but it is a very, very strong start to this truncated week. If for the bulls, you're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me today is Reema Tendulkar. Reema, good afternoon.
Hi, good afternoon. You know, at no point of time, the bulls have got a dip to enter in, right? We've had a gap up opening and the Nifty is held above 23,300. It's like an absolutely straight line that intraday will come up for you on your screen. 500 points up on the Nifty. The Sensex is up close to about 1,600 points. Very strong advanced decline ratio and many sectors contributing on the upside.
No, almost every sector contributing to the upside. Except FMCG. Yes, seeing some profit booking after the up moves that we've seen during the times of the market volatility. But otherwise, a lot of these stocks have done fairly well for themselves, be it the defense names, be it the other PSUs as well. Of course, we are counting down to earnings from Ireda as well. Later in the day, you can see Mazgaon Dock is up almost 9% in today's trading session. A lot of these defense names have done well today, in line with how the other PSU stocks have moved, and the broader market has moved as well. The broader markets have done fairly well for themselves as well. But the story of today has been the auto names and the auto ancillaries as well. The Midcap index is up 1,000 points as well. So good recovery there as well from lower levels. But the auto stocks are the ones that we were mentioning, right? Samvardhana, Motherson, Sona, BLW. Even Tata Motors is doing well for itself, among the top gainers on the Nifty. And that is after US President Donald Trump said that he's considering a modification to the 25% tariffs on auto imports. And Sudarshan is here with more details on that. Sudarshan.
The sector is the biggest outperformed today, and all the stocks are somewhere up in the range of 5 to 8%. But two stocks that have been outperforming the most are Samvardhana Motherson and Sona BLW. Both the stocks are up somewhere more than 6% each. And it's on the back of the announcement that have come over the weekend by US President Donald Trump. And
WPI numbers for the month of March are on your screens now. 2.05% is the number that has come in, compared to 2.38% on a month-on-month basis. So the numbers are lower compared to the previous month. So another number that is trending on the downside when it comes to the wholesale price inflation. We'll be counting down to the CPI inflation number later this evening as well. So at least one positive factor coming in on the inflation front.
I think fuel prices were lower. You know, fuel prices had already started moderating, so that could be a positive. And even according to a few economists, vegetable prices could trend lower in March versus February. So that could explain why the WPI inflation number for the month of March is moderated to 2.05 versus 2.38% on a month-on-month basis. As he said, we are awaiting the CPI print. But from what the RBI had to say, I think the CPI inflation forecast for this year, at least for the first 3 quarters of the coming fiscal year, would be sub 4%, or at least. So anyway, I think inflation was expected to be fairly benign. But we have Madan Sabnavis, Chief Economist, Bank of Baroda, now joining us on the show. You know, the overall WPI inflation is moderated month on month. Your initial thoughts? What could be driving this?
No, I think it could be a combination of factors. I think one is that food prices have definitely come down. There's also been the base effect, which will be having a similar kind of moderating effect going ahead also. And I think more importantly, we have seen the crude oil price. I think that is something which holds a clue, because that's something which has been going in the negative region. And given the fact that based on the global dynamics which we're witnessing, there will be a tendency for crude oil price to remain well below $70 per barrel. I think this is something which gets reflected more in the WPI rather than the CPI. That's the second factor. And the third would be, of course, in terms of manufactured goods. I think even manufactured goods inflation would tend to be low, which I expect even for the month of March and going ahead. It will be on similar lines. The main reason is that we still need to see the demand side factors play out for these prices to move up, which presently we are not really expecting. So I think all the three segments would be contributing to a low WPI inflation number, not just for March, but also for the months going ahead.
Okay, manufactured products inflation at 3.07. This is a marginal increase month on month, but the food inflation though 4.66 compared to 5.94% in the previous month. And Madan, good afternoon. Thank you for joining in. See, we are counting down to the CPI number as well, and the RBI in their policy statement too has trimmed down its CPI inflation forecasts for the full year as well. Now, with this kind of number on the WPI front, what are you expecting from the CPI later this evening?
See, we have a forecast of 3.6% for CPI inflation for the month of March. But I think going ahead, we will actually be expecting this number to moderate further. This is primarily an account of the base effect, because I think that we had very high numbers last year. So that's going to translate into lower numbers, because we haven't really seen food prices actually cooling down that much in the market. So if you're actually going to the shop to pick up your vegetables, fruits, or your pulses, the prices have remained more or less unchanged, maybe marginally gone down. But I think it's the base effect which has contributed to this moderation, which will continue for the next 3 to 6 months. So I think the important part will be as to how the monsoon pans out. And information which we got from SkyMet is they're expecting a normal monsoon. I'm quite sure IMD will have their forecast very soon, which should also be on similar lines. So I think there'll be less worries in terms of food prices. So to that extent, I think CPI inflation, which has a large proportion of the weight in for food items, would be under control. The only concern could, of course, be vegetable oils, which is an imported product. That was something which could be pushing the inflation numbers up. But on the whole, I think it will mean moderation.
In fact, today IMD will be releasing their long-range forecast for the current monsoon at 3 p.m. So all eyes will be on that. IMD's forecast will come at 3 p.m. today in the afternoon. But Madan, what's your expectation of how WPI and CPI will trend, say, in the month of April, based on the first half, the first fortnight that we've seen?
It looks like that WPI will moderate further. Again, the main reason is base effect, as well as the fact that crude oil prices have actually been lower in the month of April compared to March. So I think that's why we could be expecting WPI to move downwards. In terms of CPI, I think a similar kind of trend can be seen, though I think the only worrisome factor will be the gold component, because we have seen in the so-called core inflation component, gold has been one thing which has a significant weight in the CPI, and that's something which has been doing very well in the market, which means that core inflation pressure could be there. But on the whole, well, it will be lower than 4% for sure.
All right, Madan, thank you so much for sparing time and joining us today this afternoon on this coverage for the WPI number 2.05% for the month of March. Expect that to further trend down is what Madan Sabnavis of Bank of Baroda just said. Core inflation too at 1.5% compared to 1.3%, but the food articles inflation is significantly lower on a month-on-month basis. So we take a short break here on this on halftime report. On this note, the Nifty still almost 500 points higher, continuing to remain above that 23,300 mark. More on the markets with Sandeep Bansal of ASK Investment Managers on the other side to decode whether the market rally will sustain. Stay tuned.
Welcome back. IT's rebounded gains. The biggest IT gainer today is Mastech as it reports numbers later this week. But you can also see up moves in Cyient, Tata Elxsi, Tata Tech, KPIT Tech. Remember, these are the auto ER&D. These are the ER&D companies, engineering, research and development. They cater to the automotive sector, but even others, like whether it's semiconductors for, semiconductors for Cyient or the aerospace railway. These stocks have been beaten down. Stocks are down 40 to 45% from their 52-week highs. So compared to the IT services companies, like your, say, Persistent, Coforge, ER&D companies have gotten hit harder. Today, Ambit has come out with a note, and their preference lies with Cyient and KPIT Tech. And the key reason is that after the recent correction, the current valuations of Cyient and KPIT, the current market price, factors in a revenue growth, a future revenue growth for the next, say, 8-10 years, which is lower than the historical growth rate, which basically gives you greater confidence that the company will be able to achieve it. So now, for instance, in the case of Cyient, the current market price implies the revenue of the company will grow by 2.9% CAGR from FY24 to FY34. This is lower than the historical growth rate of 4.5%. Similarly, for KPIT Tech, which we know was a big outperformer, they're saying after the correction, the current market price implies the top line of the company will grow at a CAGR of 13.5% over the longer term. Again, lower than the historical growth rate. But this is not the case for some of the other companies like a Tata Tech or Tata Elxsi, where the street is still expecting the revenue, the projected revenue growth going by the current market price is much higher than what they've delivered. So what gives you the confidence? So therefore, Ambit has a sell call. And on Persistent and Coforge, they're saying that the market price implies that these companies will grow 20% from CAGR every year, 20% compounded. So, there is just no confidence that Ambit has that they will be able to achieve it, which is why they have a sell call on these companies, and they like a KPIT and a Cyient.
A lot of these Persistence and the Coforges have been rank outperformers.
Yeah.
So
they've delivered on numbers, like a 30-35% revenue growth. The question that Ambit has is, can it continue, right? You are saying that these companies will continue to grow that for the next 10 years. Like that's not perpetuity, but for a very long time. So there are cycles in this.
As they say, it's hard to get to the top. It's equally harder to sustain being there. But we'll continue this conversation with Sandeep Bansal, the Deputy CIO at ASK Investment Managers. Sandeep, good afternoon. Thank you for joining in. Since we are on the subject of IT, we'll get to the markets in just a bit as well. But IT has been the focal point, right, of this entire conversation, with the US fearing that it will slip into a recession, maybe in the second half of this year, maybe in 2026. Stocks have been beaten down, but despite being beaten down, they are still expensive. What do you do in a sector like this where there is a lot of fear compared to greed? Do you still take a bet here, or do you stay away from it and look for better opportunities?
We think that there are better opportunities available in the market than the IT sector because the uncertainty that is surrounding the sector is just too much. There are too many variables at play, which will be difficult for us to figure out. And while the stocks might have corrected from their peak levels, they are still not attractive given the likely growth that is going to pan out. So our idea is more to focus on domestic oriented businesses, more to focus on manufacturing oriented businesses, rather than have exposure to sectors like IT, which are more of a macro play on the entire US economy and discretionary spending, wherein the risks could be relatively higher.
Right. So what are these better opportunities, Sandeep, that you are spotting in comparison to IT? What's on your radar right now after this recovery that we have seen from the lower levels as well?
Yes, there has been, around a 5% kind of a recovery in the markets. Maybe the broader market, specific stocks have rebounded more sharply. But we believe that still there are opportunities which is available, on discretionary consumption. We are likely to see the boost from the tax cuts flow through the next year. There is anyways a uptick in the rural economy. Urban consumption is also likely to bottom out in a quarter or so. Then there is going to be the pay commission effects that is going to come in from next calendar year onwards, perhaps. So discretionary consumption is something which we are bullish on. It's a domestic granular story. In addition to that, domestic manufacturing infrastructure, these are businesses that we continue to like. We believe that this entire tariff episode that is playing out ultimately is going to lead to an advantage India kind of a scenario. Obviously, there would be short-term hiccups and pains because supply chains take a lot of time to reorient themselves, and there is potentially a global growth slowdown as well. But once all of this settles down, Indian manufacturing should end up as a big beneficiary. Infrastructure, we believe, especially on the power side, government thrust and capex continues, and there are various ways to play the entire power story. In addition to that, healthcare as a space is something which we like. While there is an overhang in terms of what could be the ultimate tariff announcements on the entire pharma space, given its essential nature, given the fact that Indian companies contribute around 40 to 50% of the generics market in the US, we believe that we have a solid footing, and the impact of tariffs, if at all, might not be that high. In addition to that, there are domestic-oriented pharma plays also available, which we think will continue to do well.
Okay. Hi, this is Rima here. Talking about the India manufacturing opportunity. Now, there are companies like a Dixon, there is a Syrma SGS. Now, Dixon is, in a way, a little bit stolen a lead over Syrma SGS purely in terms of a stock price. And then there is that added tailwind about electronics because Dixon supplies to a Motorola. So it's got a bigger play in the smartphone market, which could shift to India as it's disadvantaged China. So can you tell us, because in your top holdings, you've got a Syrma SGS. So a lot of our viewers ask us, why not Dixon, right? Why is Syrma SGS? So give us your thoughts on this.
So Rima would not be able to talk stock specifics, but we have quite a few names across our different portfolios in the broader EMS space. There are different drivers for each of these stocks. But if we look at the broader sectoral story, the Indian EMS space only caters to a fraction of the domestic consumption requirement, and the export market is a multiple of that. So even if we are able to just fulfill the domestic requirements of the next few years, there is a huge headroom for growth that is available. In addition to that, we will see this global diversification of supply chains, wherein perhaps there is going to be a higher levy of tariffs on China, which is going to incentivize the move towards India. If we look at these different plays that are available in the EMS space, each of them has, while the businesses are quite similar in one sense, in another sense, there are different drivers for each of them because they have their own niche areas which they cater to. Some of them could be more diversified. In few cases, valuations could be more attractive. In few cases, the return on capital employed or capital efficiency is very good. And in a few of the other cases, there are newer growth drivers in terms of adjacencies to their businesses or backward integration that they are doing. So we actually like the entire space.
Sandeep, because of all of this tariff-related drama that we've been unfolding over the last couple of weeks, there are a lot of sectors that are hanging in the balance right now, be it auto, be it pharma, with Donald Trump saying one thing one day, the other thing the other day. Now he's going to consider tariffs. He's already warned of pharma tariffs coming in. So let's ask pharma here. What do you do in pharma? Because most of these companies, say for the likes of Gland or Aurobindo, they have significant amount of revenue coming in from the US market. How does this significant quote-unquote tariff imposition impact a sector like pharma, and how do you position yourself here?
Yeah, so, a few things are relatively certain in this environment. Maybe for the market for now, the peak of fear is behind because of the various reprieves that have been gotten around in the tariff drama over the last few days, whether it be in terms of imposition of timelines or, certain sector-specific carve-outs. Second thing is that markets and tariffs are going to remain uncertain for a length of time because there's been a 90 days window. The US perhaps has to negotiate 75 to 90 trade deals with different countries during this period of time, which seems quite unlikely. So this tariff uncertainty and overhang in the market is going to continue for the next few months. Perhaps the market will learn to make peace with it and move on. Thirdly, it does seem that in the overall scenario, it is still going to be beneficial for India. As far as the pharma sector is concerned, what we like are plays that have a mix of domestic exposure primarily, but also domestic plus overseas exposures. In the US market exposure, what we believe is, given the essential nature of pharma, given the fact that Indian producers are 40 to 50% of US generics market, given the cost advantage, given the scale efficiencies that India can offer as a country, And given the timelines associated with reorientation of supply chains that might be required, we believe that the ultimate impact on India might not be as severe as the market might be fearing at the current point in time.
All right, Sandeep, thank you so much for sparing time and joining us today with your views on the various sectors that are currently in the news. Time to take a short break, but just before we do that, here's some good news for our viewers. India's business news leader, now just a click away, and that is CNBC-TV18's all-new app, where you get instant access to breaking news, in-depth articles and financial world updates, all of it at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. Take a short break, back on the other side.
Welcome back. Markets holding on strong, 500 points up. Just take a quick look at some of the big mid-caps which are moving around. Fino Payments Bank, 17% higher. Inox Green, Upper Circuit, 16% up. SH Kelkar, Data Patterns, Goldium, KEC International, and Mazgaon Dock Ships, where the street is awaiting that dividend. These are some of the big movers on the mid-cap end. Sachidanand Utekar is now with us for a quick technical check on the market. Sachidanand, at these levels, is there a buying opportunity? Because the dip hasn't come through, and your stock calls.
Good afternoon, Nima. Good afternoon, almost. I think clearly the market momentum has been very strong and very significant. Even if you look at the Nifty Bank, especially, it has broken about that 25th March high of 52,000, and it is sustaining well. So if you look at the contribution slate, clearly, banks are leading from the front. We're expecting this rally in Nifty Bank to continue towards 54,000 eventually. If you look at the OI data as well, there's a very convincing base at around 52,000 which has been built in. And we may see a strong elevated rally towards 52,650 during this particular week itself, followed by a move towards 53,400. When we look at Nifty as well, almost 70% of the fall has already been covered. And the way, writers are confident at that base of around 23,000, I think that particular base will also shift towards 23,300 eventually. And even here, we are expecting this particular rally to continue towards 24,000. So it's a long, call on both the indices. If you look at Nifty Bank, the conviction is much more higher. One can place a stop loss somewhere close to around 52,260 on a closing basis. And long positions can still be added for a target of around 52,650, which could be achieved during this particular week itself. When we look at the stock calls, Kotak Mahindra Bank is, has displayed a fresh breakout from its bullish flag formation. The pattern is indicating a price target towards 2250. Stop loss can be placed at around 2090, and fresh long positions can be added here. The other stock on our radar has been Bajaj Finserv, which we have also recommended to our clients. If you look at the overall weekly structure, there has been a very strong relative outperformance by this counter. On the weekly scale, we have a kind of a cup and handle formation, indicating a price target close to around 2090. So the reward to risk opportunity is still better. One can keep a stop loss at 1940 on a closing basis and still continue building long positions for a trading target of around 2040, followed by a positional target at around 2090.
All right, Sachidanand, thank you so much for sparing time and joining us with your views on the index and on specific stocks as well. And a small programming note for our viewers, CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code and submit your entries for the SME Champion Awards Season 2. Take a short break. Back on the other side. Welcome back. 515 points higher now on the index. So the bulls are in top form as we speak. But it's time for our special offering, Quarter Se Quarter Tak, where for the first time we bring you key earnings expectations from the insurance sector. And who better than Yash to summarize what's expected from this sector in the fourth quarter? Yash.
Well, Hormaz, as you rightly said, 13 companies listed now from the insurance sector, 2 as far as a part of Nifty is concerned, and for the first time that we're covering the insurance sector as a part of quarter tuck. As far as the fourth quarter is concerned, not expected to be one of the best quarters for the life insurance sector, but some players certainly expected to throw positive surprises here and there. For the industry, private players are expected to grow their annualized premium equivalent or APE in the range of 13 to 15%. That's a wide bracket to consider, but as I said, positive surprises expected from 2 companies, HDFC Life and SBI Life Insurance on the APE side, whereas ICICI Prudential Life Insurance, which reports its earnings today, could throw a negative surprise. Let's now talk about individual companies. The street is expecting a 15% APE growth, 16% VNB growth and a 26 basis points margin expansion for HDFC Life. A balanced product mix is likely to aid strong growth when it comes to value of new business and margins for HDFC Life. From ICICI Prudential Life Insurance, APE is expected to grow by about 3%, VNB by about 7%, and margins could see an expansion of 30 basis points coming in at about 21.8%. For Axis Max Life Insurance, total APE, that is expected to see a double-digit growth of about 10%, VNB at 2%, but the sour point for Axis Max Life Insurance is the margin decline. That could happen by as much as 216 basis points, coming in at about 21.6%. For SBI Life Insurance, total APE is expected to grow by 5%, VNB by 3%, and margins contraction by 43 basis points. Despite that contraction, SBI Life is expected to have the highest VNB margin in the industry at 27.87%. Though APE growth could be muted for SBI Life because of the transition away from bancassurance as a channel and slow growth as far as the ULIP portfolio is concerned. Finally, for LIC, very weak numbers expected. APE expected to decline by 17%, VNB expected to decline by 9%, but the focus on the non-par segment can bring margins higher as much as by 170 basis points to 18.9%. On the valuation front, FY26 basis, HDFC Life trades at 2.3 times price to embedded value, ICICI Prudential at 1.5 times, SBI Life at 1.9 times, and finally, LIC, the cheapest amongst its peers, at 0.6 times FY26 price to embedded value.
Thank you very much for that. We will slip into a very short break. We'll come back with more on the markets and individual stocks. Stay tuned. Welcome back. It's time now for an exclusive conversation as Trump's tariffs continue to disrupt global trade. How is the global economy adopting to and adapting to Trump's new world tariff order, and how is India positioned to navigate the tariff threats? To discuss all this and more on global trade, Shireen Bhan caught up with Bob Sternfeld, Global Managing Partner, McKinsey, and Rajat Dhawan, Managing Partner, India, McKinsey. Listen in to excerpts from that conversation.
When you talk to clients today, what are they telling you? Is there a sense of panic? Is there a sense of fear? Is there a chilling effect that nobody wants to do anything at this point in time?
Well, it's great to see you again, Shireen, and thanks for having me on. And yeah, I would start with, it's clearly the context. There's a lot going on in the world today, but if you take the lens of at least what I'm hearing from CEOs around the world, which I think was the departure point of your question, I think it's very different than a year ago. Okay. So if we backed up a year ago, most were saying, and you were clear on this, that, hey, 2024 is the year of elections. Mm-hmm. And there were more elections around the world than I think in any year in recorded history. And so as a result, many CEOs were saying, let me wait and see how things play out. Let's see what happens with this particular election, and so if I can defer some decisions, I will, and I'll play for time. Well, you fast forward to the beginning of 2025, and folks are saying the elections have happened. Yeah. The world's no less volatile, and might even be more volatile than it was a year ago. But I can't afford to wait. I actually have to make decisions, and I find that's one big departure point from even 12 months ago, that despite this volatility, there's a real desire to still need to move forward.
You know, when you talk about moving forward, and as I pointed out, CEOs are used to dealing with uncertainty and ambiguity, but in a situation like this, where on an hourly or even on a minute-by-minute basis, you don't know whether a tariff is going to stick or not stick, whether there's going to be a further hike or there's going to be a rollback, as we've seen in the last 2 weeks. How do you make decisions in this environment? And are people now essentially saying, let the dust settle before we make big calls, whether it's capex or expansion? I mean, that's the kind of feedback that I'm trying to understand how that's playing out.
I think you're really getting to the root of the issue here. And how do you make decisions given so many different impulses, and the fact that these inbound new bits of data can happen multiple times a day? I think all of us look at our phones many times a day to see what's the what's the latest, particularly coming from my country. But you know, what I hear from CEOs underneath this are a few things that I think are useful in these times. And on the one hand, making long-term decisions on things that may not have long-term assurance is not a recipe for success. And so many CEOs are coming back to a couple principles that at least I hear. One is the notion of resilience. How resilient is my company to future shocks going forward? Because these may not be the last. And I'm hearing more and more, I may need just to plan for a world that is fundamentally volatile, as opposed to hoping for a return to some kind of normality. And so how resilient is my company? And the resilience notion is not just defensive, but how do I have enough capital, enough talent to make a few bold bets while I protect myself from shocks? So I hear resilience as one. The second thing is this notion of timeframes. Will the decisions that I'm making be durable over the time frame of that investment decision? So if it's moving a supply chain, if it's developing a natural resource, if it's making an R&D decision, these are often decade-plus decisions with decade-plus payback cycles. And so what I often find is, how do I marry the return profile with the volatility profile to say, is this something that is robust no matter what? So take a practical example on this. Many are asking around the world, how much of my supply chain should I have in the US, right, given tariffs? Well, if you back up, we had done some work in the pre-tariff era that said supply chains aren't resilient enough, that COVID and the Russia invasion of Ukraine showed that we actually had fragile supply chains. And there was a logic for moving part of your supply chain closer to the source of demand. The US is the largest source of demand, irrespective of tariffs. And so several CEOs are coming back to that foundational logic to say, would I make this decision even without tariffs? What portion of this is robust long-term, based either on resilience logic, long-term demand logic? That's a practical example of this time frame piece. And maybe the third thing I'm hearing, if it's resilience, time frame synchronized with the investment decisions, the third is this notion of where are no regret moves just to speed up? And in particular, one of the topics that's around that is the implementation of new technologies to change my business. No matter what happens in the world, I am going to have to implement technology faster to change my business. That's a no regret move. And so I'm often asked the question, Bob, what are the no regret moves that I can be implementing irrespective of these external stimuli?
The role that you believe India is likely to play, when we look at what happened in between 2017 and 2024, and this is the data that McKinsey has put together, the beneficiary of the supply chain diversification out of China was to the ASEAN region and more to countries like Vietnam. So India has seen an incremental uptick, but perhaps not to the potential that it would like to see. How do you believe that's likely to change?
To the future growth potential for India, and you start with manufacturing. India is nowhere near its full potential around this. And, you highlighted, I think, a success story. I think you have to hand it to Vietnam. in how quickly they moved. But on a relative basis, Vietnam's small. And Vietnam now is facing all of the secondary issues, labor shortages, supply chain issues, overconcentration, et cetera, that India won't face for a while. And I think this is really the moment to now move from a catalytic change that has started in India about this notion of a strong manufacturing base to now kinking the curve and really starting to drive acceleration at scale. And so I am very excited, and I'm excited because you root this logic not in tariffs, right? You root this logic in the fundamental notion of resilient supply chains. And therefore, from an investment decision, whether you're an Indian company or an MNC, looking at Indian manufacturing and Indian supply chain, you can get excited about making that long-term investment.
And you believe it makes business sense, irrespective of whether the tariff differential varies and India stands to benefit at this point in time or not?
Could be, just building on that, I think there could be granularity to that approach as well, right? And granularity at two levels. I think firstly, where are the end markets? I mean, if you are really exporting, manufacturing in India for the world, we cannot be super competitive in everywhere, right? I mean, you have to pick your. It's like going and winning Olympic gold. You pick your categories,
pick the categories,
as opposed to saying in all the 120 sporting categories I'll win a gold. You say here are my 10 or 12. I think that analogy plays out even in manufacturing. We actually have identified 10 to 12 value chains. In fact, further segmented into saying we are already competitive globally. Let foreign capital come in here. Let it create jobs. Let it create investment, and let's scale. Pharma formulations is one of those examples. Auto components, specialty chemicals. I would call them as the scale industry. Just build scale from 20-odd billion of exports towards 1,800 billion.
Interesting conversation, and you can catch this full conversation today on Global Dialogue, 6 p.m.
Welcome back. Joining us on the show now is Sumit Gupta. He's CEO at Waseda Commodities. Sumit, thank you so much for joining us. And I want to start, first of all, with wheat itself, because various statements in Parliament as well, where the Rabi harvest is on. And we do understand that 38% of wheat harvest already is done. What is your sense on, one, how would you look at the numbers? Do you also think that the target that has been set out by the government in sense of procurement would be met this time around?
Hi, Manisha ji, good afternoon. I think wheat is the most critical commodity when it comes to food security in India. And from that point of view, Government of India making statement in Parliament shows not only the importance of commodity, but also how central it is for the food planning of the country. And you're right, approximately if out of 38% of the total harvest that we are talking about, largely 70 to 75% of the harvest in central and western India is done. We have just started harvesting in North India, especially Haryana, Punjab, and UP, but rains last week has delayed it by another 1 week. So you might see that harvest pace slowing down in this week and picking up again in the coming week. In terms of procurement, government has procured around 3 million tons as of now, largely in MP. And I believe government will be able to procure somewhere around 24 to 26 million tons of wheat. Because the pace of arrival in MP is extremely good. And once this time it will not slow down, it'll go away. So we'll do around 6 million tons in MP plus Rajasthan and around 20 million tons in Haryana plus Punjab plus UP.
Sumit, also, we've seen a lot of uncertainties in the last 2 years when it comes to wheat. We've seen some policy actions as well. This year, would you say, is going to be more sane than what we've seen in the last 2 years?
My answer is going to disappoint most of the people, because my answer will be no, because it is not a question of our supply going up. It is a question of our demand revolution in this country, which Government of India should be proud of, because it shows that the benefit of the economic revolution which this country is witnessing is percolating to every strata of the society. They have more money to spend, and as they have more money to spend, they are spending on food first. And wheat, from that point of view, Government of India give around 5 kg of wheat to 800 million people, wheat plus rice to 800 million people for free across the country, which takes care of the food security largely. But the ratio of wheat and rice keeps on changing depending on the stocks that Government of India has. And this year also, I don't believe wheat stock is going to be comfortable because if Government of India procures more, they leave less in the open market.
Sure. Sumit, so when you say that the wheat demand or the consumption in the country has been growing, what number are you putting it as wheat consumption for the country, and what percentage growth number are you seeing year on year?
Very interesting question, because in India, whenever we talk about numbers, we only talk about supply number. Even Government of India, whenever they publish supply numbers. And this year, Government of India supply number is around 116 million tons. Last year, it was 112 million tons. And year before that, if I'm not wrong, was around 108 million tons. But largely, but we are not building stock. That means whichever number you go with, it means our supply is equal to demand. As privates, we take India's supply number at around 100 million tons and demand number at around 96, 97 million tons, okay? Which means whatever we are producing, which we are consuming. And it's a change in production that matters, and we don't foresee that there is an increase in production this year over last year. To your question number 2, what is the change in consumption level we are witnessing? If you look at the delta of income and urbanization in India and population, our population is growing at around 1.6%. Income level and urbanization is another 0.4%. So our net demand in India is going up between 1.8 to 2% per annum, which is around 2 million tons per annum on wheat alone.
The other question really is about the weather, and while we've seen those heat waves and those hailstorms even as the harvest is on, would you say that it has impacted the harvest or the cut crop in some sense?
I will say wheat is a fairly resilient crop, and number one, it has delayed harvest for sure, okay? Because Baisakhi, as we know, is the harvest festival in India, and on 14th, and rains and hailstorm happened around 11th and 12th in North India, which has delayed our harvest by almost a week. So I will say now the full pressure of harvest will be around 17th and 18th. It has done any harm on the quantity? Answer, I don't foresee in a big way. On quality, few pockets of North India may have luster loss or potia problem, but it will be largely limited. So there should not be any big concern or flag because of that.
All right. So whether or not a major concern right now, wheat has been resilient, and the numbers that you've shared with us, Sumit, do tell us that the consumption really seems to be increasing, production not as much, while this year, of course, the final numbers that we see is something that we'll keep an eye on. Thank you so much for joining in. Well, that's the view coming in for the agriculture space. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.